It's just loading. 1 second.
Okay. Hello, VIP group for Empowered Women of Chicago. We are so excited to have our Saturday special with Marla and Michelle here. They are a real estate agent and a broker in Chicago. Where are you guys in Chicago exactly?
Well, we're everywhere. We serve the whole Chicagoland area, and yeah, we're all over the place. My technical office is at Belmont, right off the expressway, but I work remote, and everything is remote, so we serve the whole state.
Awesome.
I serve the whole state. Michelle probably has a more limited region.
So my office is in Lincoln Park, but I live in Berwyn, and I'm familiar with the city of Chicago and the surrounding suburbs. So I always tell people, talk to me about what your goals are, and I'll let you know if I can be the best fit. If for some reason your location is outside of my service area, then I have referrals within Berkshire Hathaway as well.
Wonderful.
That's awesome. Yeah, realtors always have a great referral program, which is nice.
Yeah.
So
it's such a great topic, I was going to say, because it seems like the market is really, really hot right now. You can't go a day without seeing what people are buying and selling and how it's such a great time. And I know, Marla, you've been super busy, and Michelle, you've been super busy, and it's great. So I'm really curious and eager to see what you have to say and pick up some tips and tricks about either first-time home buying, or if we want to upgrade, or just go ahead and move into a larger space, it seems like.
Yes, especially if you need that home office, right?
Yeah,
definitely.
Which everybody does. Yeah, that's for sure. And maybe a little way to sit outside and get some fresh air too, right? A little backyard, or maybe even a balcony, just to be able to step out. So yeah, looking forward to this one.
Yeah, it should be really great.
Yeah.
We'll wait another minute or two for everyone to jump on, and then we can just jump right in.
And Meg, you're going to be monitoring questions. So if anyone watching has questions, they can jump in and we can answer.
Definitely. I'll jump on the screen and ask the questions.
And we love questions throughout. You don't have to wait until the end to ask questions, because sometimes you might have a specific question about a topic that we're on, and we'd love to have it be conversational today.
Definitely.
Yeah, that's a great idea. Mm-hmm.
So yeah, Purse Strings has really been excited to be in this group of all these empowered women. We work on providing financial education for women and having Purse Strings approved providers, which Marla and Michelle both are, which are people who really understand the female market, will have your best interest in mind, are not working on selling you a product, but really giving you what you're looking for. You know, Michelle and Marla would be working on getting you your best ideal home and the best ideal price, or the best loan you can get to really fit your situation. And so that's what we love about our Purse Strings approved providers, is that they always have our clients' best interest in mind and really know how to treat people with respect and just kindness. Crazy. So,
it is funny that's crazy.
I know, right?
Should we jump in, or do we?
Yeah, I was going to give a little intro to both of you, and then we can get started. How's that sound?
Perfect.
Sounds great.
Oh, all right. So Marla has been consistently ranked as one of the top mortgage loan originators in the Chicagoland area. Her expertise with unique loan programs and creative loan structuring, her commitment to top-notch customer service, and her diligent efforts to make sure every client is matched with the loan program that best meets their qualification and their goals set her apart in the industry. And then we have Michelle, who focuses on achieving real estate's goals. As a realtor, she is an advocate and a fiduciary. Through education and the process in market, she helps her clients make moves to invest in themselves. As an added bonus, she is very experienced with renovations. She has built her real estate career around helping clients create and achieve their real estate goals. Not sure where to start? She provides the savvy investor and the first-time home buyer experience tailored to their specific needs. And I think that is a bit what we are going to talk about today. So with that, I'm going to give Marla and Michelle the floor.
Great. Thanks, Maggie.
Hi, Marla.
Hey, Maggie, are you popping the slides up? Hey, VIP people. Everyone enjoying the nice weather this weekend?
I certainly am. Even if I'm catching up on things on my computer, if there's sunshine coming in, it's a mood changer for me.
Agreed. All right, so we've got the slides up. So Maggie did our introduction, so that's us. So awesome. Let's move on to the content.
So again, just to set the tone, we do want you to ask questions. So if there's questions along the way, feel free to chime in. If we have questions at the end, we'll try to answer them. And the big picture is that Marla and I together want to help you create a plan for your success. So there's going to be some questions that we can answer that are group questions, and then there might be some questions that are personal, and we'd love to set up a time to talk about them with you one-on-one. So we also wanted you to understand that, there's a lot of different types of real estate out there. And it can be real estate for a home. It could be real estate for an investment. We don't want you to think that any of these are limited to any of those different scenarios. So a single family home, you can buy it to live in. You can buy it to rent it out. Condo, townhouse, same thing. You can buy those to live in. You can buy them to rent them out. And then obviously a multi-unit building, you could buy it and live in it, or you could buy it and it could be just a purely rental scenario.
This one, me?
Yeah, let's go back and forth. I feel like I'm doing all the talking.
All right, so the buying process, the first part before you start looking at homes is really just preparing to buy. So you're going to meet with Michelle, meet with me, and really go through the nuts and bolts as far as what you're looking for, setting the expectations, understanding your options, and then personalizing the plan. So, and the plan is different for everyone. Everyone has different budgets, different qualifications, different loan programs, different neighborhoods they're shopping in. And so to get all of that hammered out first, so we all are on the same page as a concrete plan to move forward, and then you start looking at homes. So that's the beginning part of the process.
And there's no wrong way to start. If you talk to me first, I'm going to talk to you about the buying process, and the first step is going to be talk to Marla. And if you talk to Marla first, she's going to talk to you about your home buying plan from the perspective of the finances, and that's going to be a great start. And then you can talk to me and we can talk about what the property search piece looks like.
So just the rough agenda, we're going to cover these topics on the next slide. So how do you know whether it's better to rent versus own? Some additional bonuses to buying, how you assess and put together your plan, whether you're mentally and emotionally ready, whether you're financially ready, and how to prepare for that. And then we're going to give you the roadmap of what is the process and what to expect. And then, of course, go through your questions and answers.
So we wanted to have a conversation with you about rent versus buy, because we get this question a lot. Is it better to rent? Is it better to buy? Marla and I look at real estate as your opportunity to build equity. So if you're looking at it through that lens, then it's kind of always a good time to buy. Obviously, we need to make sure that all of the other factors about your mental, emotional, financial readiness and willingness is there. But just from a broad sense, it's kind of always a good time to buy because you're investing in yourself. Do you have any specific examples, Marla, about, I know sometimes people try to compare saving up for a larger down payment versus renting for a couple of years. Sometimes it can be still better to buy even if you have a lesser down payment, right?
Yeah, and this is sort of something that's custom to everyone's situation. So it depends what neighborhood you want to buy, what type of property, how big of a property. But because interest rates are so low, what we're finding is often people can buy a home with a similar monthly payment to their rent. So a lot of people assume that buying a home means it's automatically going to be more expensive. And that's not necessarily the case right now. And then, like you said, one of the other things people compare is the down payment. A lot of people hear, oh, I should have 20% down payment. It's absolutely not needed, but there's pros and cons to compare. So if you think about, okay, I have 3% down payment now, should I buy or wait till I save 20%? And my personal feeling is it's better to buy, because the financial benefits you're going to gain by waiting till you save 20% down payment are going to be offset by the financial benefits you're going to lose by not locking in today's interest rates if they go up. And also all of the equity that you would have built in those years while you were waiting to save. So, I mean, again, ownership, it's really, like Michelle said, investing in you, building equity. It is the number one way that most Americans build wealth, is through real estate. So we always encourage people to do it. I know there's certain things that people are like, well, I don't know if I'm ready to be responsible for the maintenance and fix things. And those are things that you can budget to hire people to do. You don't have to, handle all of that yourself. You just have to factor those things in so you make sure that they are taken care of. And even the question of, well, I don't know how long I'm going to live there. So obviously, you don't necessarily want to buy a place and sell it in 2 years, because once you add in the closing costs and realtor fees and stuff, you're not really going to make a lot in that 2 years. But just because you want to move doesn't mean you have to sell a property. If you decide you want to move, you can keep the property and rent it. And now you have an investment property that's continuing to grow and build equity, and you're getting the monthly cash flow. And then you can also buy your new home where you want to move. So then you have two properties building equity. So even if you're not sure you won't live there forever, that doesn't mean you can't own it longer term, even if you aren't sure you're going to live there for that whole time.
And that's a good point. Something that I've talked about with some of my clients who aren't sure if they're going to live in a home for an extended period of time. Before they purchase the home, we talk about, okay, well, what is the resale outlook look like for this property, or what would the rentability look like for this property? And we can actually do some calculations, based on today's market, and then kind of project where it would be in the future as well. So if those are questions that you have, it's certainly something that we can look at so that you're at least going into it with some information.
Yeah, Michelle and I are both fans of multiple exit strategies. So that you have plan A, plan B, plan C, and you're protected either way if things don't go, as you were planning on plan A, which, that's life. Sometimes it doesn't. Even with investment properties, some people, they plan to buy a property, fix it up, and resell it. But if they can't resell it, we want to make sure up front that they can rent it. So they have a plan B that will still be financially advantageous for them, even if it wasn't their first option. So definitely just being smart about how you're investing in the real estate and thinking about all your options. Next slide.
So there are some bonuses to buying. There's obviously some tax benefits. And like we said, you'll build equity. And this is a way that people build personal wealth. There's pride of ownership. And it can make you feel a little bit more stable and a little bit more secure in that it's yours now. So if you want to customize your home, I know a lot of people are really into all things DIY, and you probably watch shows and you want to, try out some of your creative expression. Well, not a lot of landlords are going to let you do that. And in your own home, you can. You can make your home function to its maximum potential for use and your needs. So let's say, you need to build out a little nook for, a desk, or, you have a lot of books and you want to put in some, built-in bookshelves, or whatever it is that would make your home feel more functional for you. You can do those and customize when you own.
A little bit more detail about equity. So some of you who might not have owned yet, you might not be as familiar with that term, or you might have heard of it and not know exactly what it is. So the equity is the value in your home, the part that, like, if you sell the home, that you'll actually get cash. So for instance, like a bank account, you have money in the bank, you can take the money out. So that's the part of the house that has the money in it, that if you sell, you can get that money. So there's equity from 3 different sources. So one is your down payment. So let's say you did a $10,000 down payment. So that value stays in the property. It's not equity that you gained additional because it was your money to start with. You just took money from your bank account and stored it in your house, but it's still your money and it's still there as a value in the house. So that's one way that we have equity in the house. The second way is by the value of property going up. On average, I think real estate increases about 3% per year. Historically, like over 100 years, of course, there are some periods where it's higher, some where it's lower. Right now, it's extremely high. I think I heard a statistic that it was like 8% this past year, or something really, really high. So your value will go up over time. And of course, like I said, some years are lower, some are higher, but over time it does increase. And when you look at a chart, which I didn't put on the slideshow, but it's pretty substantial over time because it's exponential. So the first year it goes up 3% versus on the current value, but then the next year it goes up based on that original value and the 3%. So it's a little more than 3%, a little more. So that exponential growth adds a lot to your wealth. And again, that's the number one way people build wealth. So that's the second way you get equity. The third way you get equity is by paying down your mortgage. So every month when you make the payment, a portion of the payment goes to interest, which is the bank's profit, and that's, doesn't do anything for you, but a portion of the payment goes to pay down principal, which is the loan's actual balance. So if your loan starts out at $200,000, after the first month, it's, $199,700 or, whatever it is. Every month it's a little bit paying down. And in the beginning, it's a very small percentage of the payment that goes to the principal. But the longer you own the home, the bigger that percentage is every month, that a larger part of the payment pays down the loan. So with a combination of those streams of equity, I mean, if you buy a $300,000 house, and you keep it 10, 15, 20, 30 years, I mean, you're easily going to double, possibly triple your value. I don't have the exact calculations in front of me, but it's a substantial growth. And again, that's what people are talking about when they're talking about building equity. And so there's the next question is, what do you do with that equity? So one thing is, once you pass away, that could be inherited by your family. And so they can use that money for down payments on houses they're buying, or to send the kids to college, or whatever tools they want. But in the meantime, you can also actually borrow against that money. So you don't have to wait till you sell the home or pass away to get the equity. You can take loans against that for college for your kids, to start your new business, to buy another piece of real estate. You can leverage that equity that you've built. So yeah, that is what equity is. And again, if you guys do have questions, feel free to jump in, and Maggie will let us know what your questions are.
So with the financial piece, we also want to make sure that we're setting expectations mentally, emotionally. And I think, again, this is going to be one of those that is unique for every person. So, there's so many different reasons that people are ready to buy. Maybe, like we talked about earlier, maybe you need more space, maybe you need less space. Maybe you want to have an investment. Owner-occupied investments are possible as well, where with the multi-unit building, you could buy a property and rent out 2, and then you live in one. And then emotionally, maybe you have a new job. Maybe you got a promotion. Maybe you need to move for your job. Maybe your family is growing. There's lots of different reasons, but talk about those, because that goes into what Marla and I can help you plan for. So we want to know the full picture, and we want to make sure that your plan is customized to you. And honestly, for the financial part, assessing, planning, talking to Marla right at the beginning, it's really the way to go. You're going to hear us say it more than once, that talking to Marla 6 to 12 months out is a great idea, because it can really help set those expectations.
And I guess the other thing I would say is, be wary of believing myths. There's a lot of misconceptions out there, and you may hear them from, people that are, people you respect and trust, but they have certain notions about real estate, and they may tell you you have to save 20% down payment, or you shouldn't buy until you're ready to settle down. And they might tell you horror stories about, yes, you have to do some maintenance on the house and something might go wrong and you have to pay for it. And so be wary of that, because there are people in your life that may be naysayers, but make sure you're getting correct information and listening to the other side as well before making a decision. Because those things can be offset. Like, yes, you may have to do some maintenance, but again, with that equity you're building, the value you're creating and the wealth you're building is more than the cost of that maintenance. And if you're properly budgeting for that and setting money aside every month in an account so that you have a fund for maintenance, when something comes up, it's not going to be a surprise. You'll have budgeted for it because you know that owning a home does require maintenance. So when people aren't saving for it and something goes wrong, obviously they're surprised and now they're scrambling to come up with the money. But as long as you're being smart about it and budgeting and setting the money aside, and you've properly educated yourself so you know these things are coming, you can make an educated decision with the correct information, and just be wary of people who are giving you misinformation, because in times have changed. They may be giving you information that pertain when they bought a house, 30 years ago, or, things are different now. So it's not like they're intentionally giving you inaccurate information. It just may not be current, based on what's available now.
Hi there, ladies. We do have a question for you, and that's, you keep saying about planning, having a fund almost for your house, so in case things go wrong. For new homeowners, how much would you recommend is in this account? I mean, I know there's small things like light bulbs, but there's big things like a furnace, which I don't know much about, but I'm sure it's expensive, So what would you recommend? How much would you recommend either putting aside or having in an account for these home expenses?
So some of those items I do think are going to come case by case, because based on the property that you buy, every property is going to have a home inspection. And through the home, you don't have to have a home inspection, but I highly recommend you have a home inspection.
Yeah, agreed.
So the home inspection report serves two purposes. It helps us when you're purchasing the property to understand all the ins and outs of the property. And it also serves as a reference once you've purchased the property to go back to of like, oh, some of these items weren't major important items, but I definitely want to have a list going of all these things and proactively check them off my list to just help with my home maintenance. And I have a list that I give to my clients as well of suggested home maintenance items. So, part of it is going to be property specific. Part of it is going to be general, like every home should have XYZ maintenance. And I think that it would be easier to identify like a number. I mean, some people say, oh, if you save, I don't know, like whatever your mortgage is, if you save 10% of your mortgage aside each month, like let's say your mortgage was $1,000 a month. If you saved, $10 a month, $10 to $100 a month, like that might be enough. In the I'm not the finance person, but if you saved $100 a month, it might be a good starting point. I don't know if Marla has any like ratios on that, but I just feel like it's hard for us to give an exact number if it's not property specific.
Yeah. Now, I was thinking exactly what Michelle was thinking, is it's very specific. So for instance, if you're buying a condo, you're only responsible for what they call walls in, right? So you're never going to have to deal with a roof, tuck pointing, a lot of that major stuff is taken care of, even the regular, like mowing the lawn, shoveling the snow. So, and we'll talk about condos in a little bit, but with condos, there's a monthly assessment. And so that is the same as what we're talking about saving monthly for it. You're just saving through the association, and everyone in the building is collectively saving. So you don't personally have to set as much aside for yourself, just things you might want in your unit, because I mean, maintenance problems inside a condo are going to be much, much smaller. So you don't need as much. So if you're buying a house, obviously then you're responsible for the roof and, everything associated with the property. But it depends on the condition of the property, the age of the property. And so really, like Michelle said, doing that projection of, okay, did the inspector say the roof will need to be replaced within the next 5 years?
Right.
Figure out what that's going to cost, and then back into how much do I need to save for that project. So it's really like, older homes that haven't been maintained as well, you may need to save more monthly, but there may be a trade-off that you can get those homes at a lower price when you buy them, right? Because obviously you don't want to spend top dollar for a house that's a money pit. But if you're getting a discount on the purchase price and then investing some in maintenance and, repairing the property. But yeah, I would really work off that inspection report. That's definitely the best place to start for again, custom to that situation.
Awesome. That's some great advice. And then I'll let you guys keep going.
Thanks. Am I doing this one, Michelle? We should have made a little code in the corner, like Michelle for Marla's turn.
This one we sort of covered, but I think that we can touch on it if you want.
No, I think we covered it. Let's go to the next one, Maggie. There we go. Okay. All right.
Seems like a lender.
So first of all, don't stop reading the screen. I know when screens pop up, people try to read stuff. Don't read the screen. Listen to me. The first thing you need to know is that you don't personally need to know all this stuff on the screen. I'm going to give you an overview of it so you can know what I'm looking at. But this is all stuff I'm going to figure out and then give you your custom plan, because the answer to each of these steps is different for different people. And so I'll give you a little bit of the inner workings so you have an idea. But again, you don't have to figure any of this out for yourself. So the first thing we look at is credit. And I did a presentation on Monday about how to boost your credit. So if you're concerned that your credit isn't as strong, feel free to watch that. We can post the link under this one after we're done here as well. And we'll talk about this a little bit more detail later, but you don't need, again, with these myths, you don't need the absolute best credit score. There are a lot of different loan programs that are available for people in different credit score ranges. The next thing that we recommend is just looking at your overall budget. And this is something that you want to take into consideration more than us. This slide calls it a monthly survival number. It's just referring to your budget, like how much do you spend per month? And there was another presentation on that went through budgeting. And so I like to start from that standpoint. When I talk to you, one of the first questions I'm going to ask is, what is the monthly payment you are comfortable with for your new home? And so I like to start from that standpoint rather than starting from the question of how much is the bank willing to lend you, because it's often the case that the bank is willing to lend you more than you're comfortable with. But I want to make sure to keep you on the budget of what you are comfortable with. So you need to do a little bit of digging to figure that out. And there's a few ways. One is you can go through the whole budget process. And again, there was a video earlier in the week on that. Another thing you can do that's sort of a quicker assessment is just look at your current rent and then see okay, am I comfortable in my current rent where, I can make the payment and still enjoy life and still save some money? Or is my current rent a stretch where I feel like it's too high? I'm cutting out social activities because I can't afford them, or I'm not saving money for emergencies. Or do you feel like your current rent is low and you could go higher? You have a lot of wiggle room. You're saving a ton of money. So that's one quick and easy way, is to just compare to your current rent how comfortable that is. The better method, like I said, though, is to go through your whole budget. And when you do your budget, the tricky part is actually to figure out what you actually spend, because I know when most people do a budget, their inclination is to put on paper like what they think they spend or what they ideally would be spending, and not really looking at those credit cards and missing oh, I didn't realize I'm really spending this much money on, brunch every Sunday, or, whatever it is. So going through your actual expenses for a certain period of time and seeing what you're really spending to get a realistic budget. The other thing I would say about the budget is planning for the future. So let's say you're planning on having kids, so that's not in your budget now. But if you're going to buy the house and stay in this house with the kids, you're going to need to think about what are those costs for daycare and diapers and all these different factors. So thinking about your budget through the stages that you may live in the home to come up with what is that number for the monthly payment that you want to be at, your preference, not what the bank tells you they want to give you. The next part is how much money you need to spend. So in an ideal world, this is not required, but in an ideal world, you would have money set aside as an emergency fund, right? And we talked a little bit about this where you're saving monthly for home maintenance. In an ideal world, you would have a lot of that money saved. So, in case you lost your job or had a health issue or something that you'd need to spend money, you have that money saved up. So this slide is recommending that you save what would be equal to 6 to 12 months of savings. That is a really lofty goal. And I can tell you, looking at people's finances day in and day out, a very small percentage of people actually hit that goal. So I don't want that to be a barrier, even though the slide recommends it. It would be nice, but you can continue to save that emergency fund after you own a home also. It's not like that owning a home is like, okay, you're done, you can no longer add to that. So you do ultimately want to have an emergency fund for any financial hardships, but I wouldn't necessarily let that hold you up for buying a home. So then the question is, how much money do you need? And that's going to be part of your custom plan. And again, the answer is different for everyone. But there are programs with very low down payment. There are some programs with 3%, 3.5%, 5%. In addition to that, there are some programs with down payment assistance. So even if it's 3% and then the down payment assistance is giving you $10,000 to help cover that, you could end up spending very little money out of pocket if this is a barrier for you. So you have your down payment, which again can potentially be covered with these down payment assistance programs if you qualify. And then you also have settlement costs. So there's a number of settlement costs that go into it's everything that goes into buying a home. So we already mentioned your inspection, there's appraisals, title fees, attorneys, insurance. There's a number of costs that go into this. And again, in your personal plan, we'll break this down in detail. But if you are short on funds, that is something that we can try to negotiate with the seller to help cover those costs. So if you want to spend the absolute least amount of money out of pocket, I have clients who regularly combine the down payment assistance to cover most of the down payment, as well as negotiate with the seller to cover a lot of the settlement costs. And I've had people buy a home with literally $3,000 to $4,000. So it can be a very small amount of money. You don't have to save tens of thousands of dollars. So with the money people are getting with the stimulus right now or your income tax refund, I mean, that could easily be enough to buy a home. I know a lot of people have an idea that they have to have a lot of money. So if you have a little more money saved, it can increase your purchasing power. It can make your offer a little stronger in some cases if the seller has multiple offers they're comparing. So, if you have it, that's fine. But again, back to what I said before, I wouldn't delay because of that. If you wait 2 years to save, a larger down payment, then you're missing out on the equity you would have built in that 2-year period of time. Plus, if the interest rates go up between now and then and you have a higher interest rate, that is going to be a higher cost over time and you'll have less purchasing power. So even if you don't have a lot of money, let's start with where you're at. And again, like Michelle said, we'd like to do a plan the 6 to 12 months in advance. So if you do need to save a little money, that's fine. You could still talk to us now and we'll tell you how much you need to save so you can work toward that goal. There's also a few additional sources of money that can be considered that a lot of people aren't aware of. One is retirement accounts. It's very common that people will take a loan or a withdrawal from their 401ks or IRAs, 403bs, whatever type of retirement account you have. And that's perfectly acceptable to use that money toward your home. I already mentioned income tax refunds are very popular. These stimulus checks, I mean, that's definitely going to get a lot of people into homes. Another source that a lot of people don't like to talk about, but is very, very common, is a lot of people will get help from their family. It's very common for people to get a gift from their parents, grandparents, whoever, really wants to help you and see you get ahead. So whether it's just a couple $1,000s or, some are quite large, depending on the family's ability. But often you don't even know that they're thinking about that, but they may have already thought about that and set money aside that they want to help you buy your first home. So if you mention, hey, I'm thinking about buying a home, don't be surprised if they pop up with, oh, we'd like to help with that. So that is an option. It's not an option for everyone. But once you start talking about it again, you'll weed out what these options are and kind of think through it. But again, the main thing is that you don't need to be intimidated by needing a lot of money. That's not required nowadays. There were periods of time where you needed 20% down payment, and it's just not the case now. And very few people have 20% down payment when they buy a home. Income, we look at your income. So the main thing with income, Maggie, you want to jump in with a question before I go to the next one?
Yeah, and I don't want to spend too much time on it, but if you take money from your 401k or any retirement fund for this, is that taxed, or does that affect your taxes? Because I can see that outweighing some balances, depending how much you take.
Sure. So there's different methods depending on the retirement plan, but often there's an option to take a loan against it versus a withdrawal. So if you take a loan, there's no taxes, there's no penalties, because you're actually paying that back monthly. And if it's for your employer, they actually take that monthly payment out of your paycheck. So it's like you don't even feel it. You're not actually personally making the payment. It's coming out of your paycheck. So obviously, if you're planning to do that, you want to take that into account in your budget, because that is another small monthly payment. So that's a way to avoid the taxes and penalties. There are some options, and I'm not an accountant, so I'm going to refer you to your accountant on this, which I know Purse Strings has several approved accountants. But there are some options with certain retirement type accounts, not all of them. But you can take a withdrawal if it's for your first home up to a certain amount of money without the penalty fee. So in that case, you may have to pay the taxes that you avoided when you put the money in the account. You may have to repay those, but you don't have to pay the penalty, because the government does try to encourage people to buy homes.
Okay, cool. Yeah, that's some great information. Thank you.
Okay, so income, the main thing with the income is we want to make sure it's stable and consistent and going to continue. So obviously, if your job is a regular salary, that is perfectly fine. That's like the gold standard in our industry. If your job is hourly or other variable income, like you have commission-based income, that's fine. But those type of income, we want to see, a pattern. So do you typically tend to work X number of hours? Or if it's commission, has your commission been stable over the past couple of years? So we can depend that it's likely going to continue. If right now we're seeing a lot of people, their income was hurt because of the pandemic. And so that's something that has to be taken into consideration. Was your commission lower? Did you work less hours? Did you have a period of time where you were furloughed? So that doesn't necessarily mean you won't qualify, but we have to dig into those questions to figure out how much of the income we can qualify you for if some of those things did affect you. For a lot of people, some people are self-employed, and so that's also fine. You can use self-employed income. Again, as long as we show that it's consistent and stable. If you just started your business last month, the bank is not going to look at that and say, okay, we trust your projections that you're going to make this much money over the next 2 years, because they can't see. They want to see that history. So if you're self-employed, you really do need 2 years of, good income to kind of show that you have that stability, because it is a little bit riskier than, obviously a salary job where you're guaranteed the same paycheck every month. Again, these are things we'll go through with you in your personalized plan. So I'm just giving you a rough idea of what we're looking at. But, once we sit down, we can say specific to your situation, this is how we're looking at income. This is how these factors affect your qualification. And if there are things that we need to adjust with your current financial situation to get you to the goal, that's part of the plan as well. Okay, the last one on here, the debt to income ratio, is one of the big ones we look at. That's how we figure out, is your income high enough to afford this monthly payment? And the formula is not very straightforward because the way we calculate things it's not necessarily what you would expect. So when we're looking at your debt, we're looking at your monthly payments. So, for instance, credit cards, we look at just the minimum monthly payment, not what you necessarily pay. Car loan, obviously, that payment's pretty straightforward. It just is what it is. Some of the other debt isn't as straightforward, though. So, for instance, student loans, there are different rules about that for different loan programs. And I know a lot of people right now with the federal student loans have no payment because of the CARES Act, because of COVID. And so the fact that there's no payments and you're not paying it doesn't mean that as a lender, we can ignore that, because at some point we're assuming that you will have to start paying it again. So we have to factor in to make sure that once you start paying it again, you can afford that payment and still afford the housing payment. So, and again, the way we calculate the student loans, it's different for different loan programs. So I know if you Google it, you're going to find certain things like the payment has to be calculated at 1% of the balance. And while that's true for some loan programs, there are other loan programs that are more lenient. So again, that has to be customized to your situation. And sometimes, and again, part of the plan is, one is looking at what do you qualify for right now, but the other part of the plan is, if you need to improve your qualifications to get to the point that you qualify for the house that you want, what are those action plans? And that's where we put together specific recommendations based on your situation. So in some cases, people do need to reduce their debt sum or shift their debt from credit card debt to installment debt, which I talked about on the video on Monday. So if that's the case where, you don't quite qualify, you're still going to walk away with that action plan of, how do I get to the point that I qualify? And what do I need to do to get there? So again, there's no harm in talking to us. You don't have to feel like I don't want to call a mortgage lender until I know for sure I qualify, or until my credit gets to a certain point, because some of the tips we can give you can accelerate that process and you can get to the point of qualification quicker, because some of the things that you may be working on might not be the best way to get to that goal. There may be things that aren't necessarily intuitive or that you're not aware of that can help you get to the goal quicker. So if you're thinking of buying a home, even if it's maybe 2 or 3 years out, you definitely want to talk to us first to get that feedback, to make sure you're taking the right steps, you're on the right path, you're not, inadvertently doing something that will actually harm your qualifications, which sometimes happens. Like, one big misconception is that people think if they pay off their debt and close the accounts, that will help them qualify. And that's not necessarily the case, because closing accounts actually hurts your credit score. So definitely get that feedback before you start taking actions, so we make sure that you're on the right path. We'll give you the budget so you can start looking, even if you're not ready to look at houses yet. You can keep your eye on the market, so okay, if my budget range is likely to be around $250,000, you can just start keeping your eye on what types of houses are available in that range and what neighborhood. And you could start thinking about those things while you're working on getting to the point that your qualifications are where they need. Michelle, any other questions? You had missed anything there?
No, I can speak from experience and just say that there's been several clients that I've referred to Marla who assumed that they weren't going to qualify, but they were really interested in purchasing real estate, and they talked to Marla. And some of them already qualified as they were, and some of them she gave some recommendations to, and now they've qualified and purchased homes. So the process works.
Thank you. And just as a side note too, not to toot my own horn, but this is not necessarily something all banks do. So don't go to every bank and assume they're going to give you this custom home buying plan. A lot of banks just look at your credit and your income and they're like, all right, you qualify or you don't, and that's it. They don't offer that additional step. So yeah, it's important to select people that are going to give you all that additional educational information and feedback and coach you through stuff, because it's not the normal standard in my industry.
I can second that as well. I can toot Marla's horn. I specifically want to work with Marla because of the educational piece, because it's important to both of us. And I've had the experience of seeing how other lenders work sometimes with the yes, you're approved, no, you're not. Whereas Marla will say, like, yes, you're approved, here's the plan, or you're not approved yet, but here's how we'll get you there. And so it's not just an automatic no, and it's really a deeper dive into your specific situation.
Yeah. Okay, and then quickly on credit, I don't want to spend a ton of time on this because, again, Monday we did the credit video, but here's a rough breakout of different credit score ranges. So over 740, you're in the top tier to get the best interest rates, the best PMI rates, qualify for the most variety of loans. 680 to 740 is also very good. I would not delay buying a home to wait till your credit gets over 740. The interest rates might not be quite as good, but to be honest, today's interest rate is likely to be better than the interest rate that's going to be available in a year. So if you take a year to build your credit so you can get a better interest rate, you've already lost the interest rate because the market has shifted in the meantime. So if your qualifications are good enough, that is good enough. You can also continue to work on your credit as you're looking for a home. So a lot of times I'll tell someone, you know, you qualify right now, here's your price range, here's all the information you need to know, go start looking at homes. But while you're looking at homes, you can also do these additional steps. So if you're successful in getting these steps done before you buy the home, your score can go up. So you can continue to work on it. And some of the tips can boost your credit very quickly. I've had clients have, 80, 90 point boost in a period of like 2 or 3 weeks. That's not true for everyone. I'm not saying everyone can do that, but sometimes it's pretty quick to get your score up. So it doesn't necessarily need to be a stopping point. So 680 is again, it's good. It's a very respectable score. It's probably more than half of Americans. 640 to 680, that's also fine. You're likely going to qualify. It may limit which loan programs you qualify for. And again, the interest rates might not be quite as good, but again, still probably better than they will be in a year from now. So in that area, that's also where I would likely say, okay, this is what you qualify for now, but here are some additional recommendations you can work on in the meantime. And 640 also is the cutoff for the down payment assistance program. So that's a big mark. If you're over 640, you can qualify for the down payment assistance. That's really helpful for a lot of people. Under 640 doesn't mean you can't qualify. We do actually have loan programs that are fine for people under 640, but it's going to limit some things. So one is, again, the down payment assistance programs require 640. So that's out of the question. You would need to have your own down payment, which would be 3.5% of the purchase price. So if you're under 640, you will need to save a little more money. And typically what the underwriting system does, it has an algorithm where it weighs the strengths and the weaknesses. So if your credit score is not as strong, but you have other areas that are very strong, your debt to income ratio is low, you have a good amount of money saved for your emergency fund, which can also be retirement money. Emergency funds don't have to be in the bank. They can be retirement, investment, other things you have going on. But if you have those other strengths, like a lot of savings and a good debt to income ratio, those things will offset the lower credit. So you may be able to buy in that range. Not saying this will happen for everyone, but I mean, last year there were 2 different clients that I was able to qualify with 550 credit scores. So not saying everyone will qualify at 550. Most people at 550 wouldn't qualify, but they had enough strength. They had bigger down payments, savings. Their debt to income ratio was really low, and so it was able to offset that. The range between like 5 to 640. That's the range where it's more likely to be able to qualify. Under 580 gets much tougher, and you definitely need a bigger down payment. But 580 to 640, we help people in that range all the time. But again, we just have to look at the picture and see, are there things we need to improve? Can we get it done the way it is? Do you need to save a little more money, or consider some other factors? So again, there's a few tips on the bottom of the screen, which we talked about Monday. Again, make sure all your bills are paid on time. Make sure you have enough credit accounts set up. A lot of people just don't use a lot of credit, and so they don't have any credit cards. So having enough open accounts, having a mix of accounts, your credit card utilization to be low, not maxed out, and then keeping your accounts open longer so you have a longer credit history. So those are some general tips. You can certainly watch the Monday video, or again, in your home buying consultation, I'll give you specific tips to your situation, which again is going to be different from person to person about what are the ways to boost your.
I just wanted to jump in here and let everyone know that on the VIP page, there's a tab at the top called Guides, and all the videos from this week are there. So you can see Monday's video, you can see the different budgeting videos, and we also have them all up on YouTube. So I just want to share in case anyone does want to go back to that video.
And Maggie was nice enough to also make one-page summaries of the videos too. So if you don't want to watch the whole video, you can read her cheat sheet. So.
Yep, all the downloads are there as well. So get financially fearless.
Perfect. So for the sake of time, Michelle, you want to just do this one really quick, just because I feel like we're already at 50 minutes and we don't want to keep people all day because the sun is out and it's beautiful.
Yes, absolutely. So, obviously with the home buying plan, Marla is going to talk to you about what your monthly payment would be and what makes up the monthly payment. It's principal, interest, taxes, and homeowners insurance. And we can get more into depth with your personal home buying plan, but it's really important to point out that taxes, that's a big factor that I think sometimes some agents don't pay enough attention to, and that can be surprising, because taxes are not necessarily the same from property to property. They're not even necessarily the same within the same neighborhood. So having a keen eye, looking at the taxes and making sure that the taxes are actually accurate, because unfortunately sometimes the agent that lists the property in the MLS puts either an incorrect amount there, or they put taxes from 2 years ago. So double checking the taxes to make sure we understand what that is. And I can show you how to do that. It's a really important piece, because the higher the taxes go up, the higher your monthly payment goes up. Likewise, with the homeowners association fees, if you're looking at a condo, townhome, or property that has a homeowners association, those fees can vary. They can be $100 a month, and they can be $1,500 a month. It's wild. You get into certain buildings, and because of all the different things that fee pays, usually when you're in the $1,000 to $1,500 plus range, you're in a lot of older vintage buildings that have, they might be right along the lake, but they have, vintage elevators and things that require a lot of maintenance and repair. And so you're paying for that as the person who's living in that building. So these are all things to be aware of. Location is everything. You want to live in the location you want to live in, but we also want to find you a property that is helping you achieve your goals and still being within your monthly budget. So.
Yeah, and real quick, on the right side above the association dues is the mortgage insurance. So that is commonly referred to as PMI. So basically what that is if you don't have 20% down payment, the banks consider you a risk because you don't have enough skin in the game. And so there's this extra little insurance to compensate for that risk. And the amount of that PMI varies based on what your down payment is, your credit score. Sometimes it's very small. And so that's why you hear people say often, I want 20% down payment because I don't want to pay this PMI. But again, if the cost of buying a house goes up, the interest rates go up, you may ultimately end up spending more than you would have paid in the PMI. So I don't necessarily avoid PMI. If it's a tool to get you into the house and you're building equity and you have the other benefits of homeownership, it just has to be factored in. So again, we can keep you at that monthly budget that you want with the total payment, principal, interest, taxes, insurance, HOA dues, the PMI, all of that together. And we back all that out. You don't have to figure out, okay, how much for this thing, how much for that thing. We give you the budget. And like Michelle said, we look at the taxes, the assessments, and make sure that everything fits together so that you end up with the total monthly payment you're comfortable with. So the PMI is definitely something we go through more in the home buying plan. Real quickly, I also want to touch on condos and townhomes, properties that have homeowners associations. So as we mentioned before, you pay a monthly fee to the association, and they use the money for snow removal, mowing the lawn, maintenance on the building, a number of things goes into that. And so one of the factors we're looking at also to protect you, and also your attorney will help with this, is to review the state of the association and make sure they are in good condition. They don't have like a ton of deferred maintenance and no savings to fix it. We want to make sure they have a healthy amount of savings. They've been maintaining the building well. Their budget is realistic for upcoming work that may have to happen in the next 10 years. So that's something that we help you review to make sure that you're buying into an association that is, responsibly managing their budget and maintaining the building as well.
Yep. And we'll touch on that more when we get to the home buying process. So we can skip to the next one. This is just a slide saying that we're going to talk about the map to home buying. So obviously, as you've heard us say this whole time, you can meet with me first. We can talk about the whole process. And then step one is meet with Marla, or you can just talk to Marla first, understand the financial piece. But definitely meet with your lender, talk to Marla 6 to 12 months before you intend to purchase, or more. If you're curious now and you want to review and see where you're at, and you're not even sure if you're going to buy in the next 2 or 3 years, you might be surprised that you actually do qualify now, and that might factor into some choices you want to make. So,
Are you doing the map?
Yep. This is our map, and so as you can see, we have a few things starred here. So, this is kind of the home buying process at a glance, but there's a few key points. So obviously, again, mortgage pre-approval, meet with your lender. The visiting the homes, the showings, identifying the one, that's all, very fun. We'll get to go look at properties once we have this correct guidelines. And then we'll write an offer. And, there's a lot of different things that go into the offer, and they're very property specific. So I like to have that conversation with people, one-on-one as far as it's part of your home buying plan. But, we're definitely thinking about things like purchase price and how quickly we can close. We want to make sure that we give our lender enough time to close, but at the same time, we have to be competitive. I'm sure you've heard that the inventory is low, and that you might have heard that it's a seller's market, which it is with the amount of inventory in. But I also like to say it's a buyer's market right now because of the low interest rates. So maybe it's more of like a win-win market. The sellers are getting.
Let me jump in on that. The part about determining what purchase price you're going to offer, there's a wide range of knowledge about that in the real estate community. I'm always surprised by the number of realtors that really don't have any clue on how to determine what the value of the property is. So they recommend to their clients to make an offer based on the list price. And the list price is really just what the seller is hoping to get. So Michelle, I know, is very good at this, but there's a process to reviewing what other homes have sold in the neighborhood to figure out what the home is worth. So you're actually paying a fair price, and not just like what the seller wants because the real estate agent didn't know how to really look at the value. So that's an important piece. And then there's other factors to look at if there's multiple offers, different things like that. But making sure that your real estate agent is competently advising you on what the property is actually worth, not just what the actual asking price from the seller is.
Yeah, so if I can just follow that up a little bit. So when we're writing the offer, I prepare a CMA, and the CMA is a comparative market analysis. So that's going to look at other properties that have sold. I have a really deep dive, spreadsheet that I use that actually goes even deeper than just looking at the properties side by side. So we'll get into all of that. For multiple offer situations, obviously when you're writing the offer, you want to be competitive. There's certain tools and tactics that we can use as far as, there's escalation writers. You can write a letter to the sellers to try and appeal to their emotional side. We can include or not include certain elements of the offer. So again, with all of that, I like to do that on a personalized basis, but I definitely take a deep dive and we'll make sure that you have all the information that you need in order to make an informed decision. And then, again, there's going to be some negotiations. Sometimes you're submitting an offer and then you find out we have to submit highest and best. So then we have to kind of go back and look at all the numbers and say, okay, is there any wiggle room here? Is there anything that we'd want to change? Is it worth it to change? And there's, again, some neighborhood information that we can look at as far as statistics, and if we think that this property is going to still meet your needs at a higher purchase price. So we'll look at all of that. If you circle around down to where it says attorney review and inspection, once we are under contract, the clock starts ticking and we have an attorney review the contract, we have a home inspector inspect the house, and depending on what earnest money was negotiated during the offer period, that earnest money would need to be taken care of as well. So the first 3 to 5 business days are a little bit hectic, and I like to just let people know that. It kind of feels like a whirlwind, but I'm here to help you get through it, help you understand what the deadlines are. The attorney is really there to help us if we are looking at an HOA. They're going to help us review all of the condo documents. There's some important condo documents that you want to know about. Like Marla mentioned, we want to make sure that they're being responsible with their money. We also want to understand what the rules and bylaws are. We want to understand if you're allowed to rent. Maybe you want to purchase a property and it's just a stepping stone and you'd want to rent it in 3 to 5 years. But what if this, association only allows a certain number of rentals and currently there's that many rentals? So that's something to consider. We also want to look at, if there's been any insurance claims against the building, things like that. We also want to look at their reserves. How much money do they have in the bank? How often are they doing maintenance? Are there any upcoming special assessments? A special assessment is an amount that's on top of your regular monthly amount of payment. And the special assessment sometimes can be paid by the seller, but sometimes is not, depending on what was negotiated. So if we find out during attorney review that there's an upcoming special assessment, then we might want to say, hey, we didn't know about this. We need the seller to agree to pay for that. So just some things to know about that. The inspection period is really important. Like we mentioned, it's kind of your checklist of everything to know about your house. There's going to be items on it. I like to prepare people and let them know that every house is going to have items on the home inspection report because they find every tiny little thing. Some things are going to be big ticket items. Some things are going to be small ticket items. So we're going to talk about, hey, what are the big ticket items? What's the big picture? What are you willing to accept? And maybe you want the seller to do some repairs. Maybe you want the seller to provide you some seller's credits, which would go towards your closing costs and down payment amount at the closing table. So, perhaps the seller doesn't have time or isn't willing to do a repair, but is willing to give you $5,000 of seller's credits. That's $5,000 less dollars that you have to bring to the closing table. So we'll talk about all of that. We'll see what we want to go to the other side with, and that will get included in the attorney review letter. Once we close attorney review, the earnest money that you put down is kind of locked in place and it's only protected by the mortgage contingency period. So you are protected during the period of time where you are seeking a mortgage. And if for some reason you weren't able to secure one, which would not be a worry with Marla because she does so much work on the front end that we know that you're going to qualify. But in the event that something happened, you would get your earnest money back. People are always wondering, when do I get my earnest money back? When do I don't? The earnest money is there. Let's say you get the clear to close and you're ready to go and you're 2 days out from closing and you pulled out. It's there to go to the seller to help them get the property back on the market. But we would understand that, and you would understand through the process. Myself and your attorney would let you know along the way, hey, this is where we're at in the process, and this is whether or not you could get your earnest money back in that process. The appraisal is ordered by Marla and her team. It's a third-party service, and we're going to talk in a few minutes about appraisals versus the home inspection, and kind of how they vary, and they're alike and different. We're also going to have you seek homeowners insurance. So we both have a couple of brokers that we work with that we recommend, And homeowners insurance is required if you're getting a mortgage. So we want to have you get that. And then C2C and set closing date. So C2C is the kind of the magic words. It's clear to close. It means your loan has been issued the final approval by the underwriter and we're ready to go. We're going to finalize that closing date and time. We'll do a final walkthrough of the property to make sure it's how you expect it to be conveyed to you. We haven't been in it for a couple of weeks at this point, probably. And we want to make sure the sellers moved all their stuff out. If they were making some of those repairs that we talked about, we want to make sure they made the repairs, etc. And then you go to the closing table and then we take pictures with the sold sign. So I know it's a lot of information, but knowing that we are here to be with you every step of the way is what we want you to walk away from this with, is that you don't have to memorize this process. You don't have to memorize all the pieces that you need to get the mortgage and all of that. Marla and I are here to guide you and to be your resource along the way.
So I would say of all of the information we have given you today, this is the most important slide because you are not going to be an expert on home buying. Even if you Google everything, watch a bunch of YouTube videos, read a book on it, even if this is not your first home, you've bought 2 before and this is your 3rd home. There's no way you're going to be an expert on this unless you do it day in and day out for years on end. So the most important thing you could do, and if you only take one thing away from this, is hiring a good team of people that are knowledgeable, experienced, trustworthy, have good customer service, are going to look out for your best interest. So your team will involve all of these people that we'll go through, but this is really the most important part. If you hire the right team that you feel comfortable with and your trust is looking out for you, you don't have to worry about knowing any of the rest because we will walk you through that, as Michelle has said. So, Michelle, you want to do the loan officer one?
Yeah, so I mean, me personally, I would probably say there's like 4 main people: the loan officer, the real estate agent, the attorney, and the home inspector. I mean, everyone is important on this list, but those are the 4 main people that you are, working with immediately in the process and that, are with you sort of the whole length of the process. So loan officer, obviously, we've talked about Marla a couple of times and how she has her spreadsheets and she really does a deep dive. I can't say it enough that working with a lender like Marla is so important because it can make or break a deal. And especially in a market that is moving very quickly, like the one that we're in right now, you want to feel confident in submitting your offers. And I mean, Marla goes above and beyond, especially in the multiple offer situations. If she knows we're in a multiple offer situation, she'll reach out to the listing agent. She'll tell them how qualified you are. She's really got your back. And I think that it's really important to work with a loan officer that has that much one-on-one time with you.
I want to add a little bit to that, not to specifically toot my own horn, but just to give you some insight on the industry. The biggest risk factor is probably the loan. Most deals that you hear that fall apart, it's because the loan didn't qualify. And so all your horror stories like, oh my God, I told my landlord I was moving out and then it didn't work out and I didn't have anywhere to go. A lot of that is that the loan officer did not do a thorough job on the front end. They did sort of like, use my French, but a half-assed job on pre-approval. They're like, yeah, it looks good, but they didn't ask all the more detailed questions and they missed stuff. They didn't accurately calculate stuff. There were gray area situations that they didn't talk to the underwriter to make sure they were willing to approve. And so it's very difficult from a consumer standpoint to tell if your pre-approval is good or not because they all look the same on the outside, but the process that went into getting the pre-approval on the back end, as a consumer, it's hard to know. Did they do a thorough job? Did they not? Did they calculate it right? Did they miss anything? So that's where it's important to get references from your real estate agent because they have a history of having worked with different loan officers and different companies, and they can tell you these companies are known for doing a good job. This loan officer is known for doing a good job. These companies I would stay away from with a 10-foot pole because they're terrible. And to be honest, I've actually seen listing agents reject offers because of what bank did the pre-approval. They're like, this bank has a bad reputation. We know they give pre-approvals, again, half-ass, and most of them don't close because they didn't do a thorough job, and we're not accepting an offer with a pre-approval letter from that bank. So again, as a consumer, it's hard to know the difference because a pre-approval letter, again, all looks the same, but to dig a little further from your real estate agent or online reviews or whatever you want to look at to get a sense that they're really doing a thorough job. And pre-approval means that in the end, the underwriter is actually going to approve the loan. You know, they're not just throwing it at the wall and seeing if it sticks. Okay, so next thing is real estate agent. So similar to loan officers, there's a wide range of skill set with real estate agents. It's actually pretty easy to get a real estate license, but just because you have a license doesn't mean that you're experienced and you're good and you know how to run those comparative market analysis. You have the negotiation skills, your customer service is there where you're available to your clients. So again, really interviewing the real estate agent you think you want to hire and asking those questions, making sure you feel comfortable with their competency, looking at online reviews to see what their past clients have, have said about them. And I mean, I'm sure Liz wouldn't have let us do this presentation if she hadn't, screened us and worked with us and known that we're competent. And I've worked with Michelle for a long time, and all of our customers rave about her. They expect, at least a certain level of service, and they all say that she goes above and beyond that level, and they just feel very comfortable, especially the clients we've had that were the most nervous at the beginning and, not sure if they wanted to do this or they were on a tight time frame. They all end up raving about Michelle. So, so the real estate agent is really important. The appraiser,
I just have one quick thing I want to add in as well, because similar to how Marla felt about loan officers not all doing the same thing. I mean, realtors can kind of look the same all on the outside, but outside of the comparative market analysis and knowledge of neighborhoods, I mean, there's other tools and tricks and also your referral network. I mean, I work really hard on having a great referral network for contractors and attorneys and home inspectors and things like that. And I only would recommend to my clients people that have a great track record, have great customer service. There's also something right now that's really prevalent that not all agents are utilizing, which is the private listing network. The private listing network is where a lot of homes are being bought and sold before they even make it onto the MLS. So sometimes people think, oh, well, what is a realtor really gonna, add to my experience? I can see everything on Zillow. Well, you can't see everything on Zillow, and there's plenty of homes that are being sold in the private network. I have 2 homes that are closing in the next month or so that were both found by me in the private network and never made it to the market. So it's important to know that as well. And, yes, you pay a realtor a fee if you're selling a home. But if you're buying a home, you don't pay the realtor a fee. The listing agent would pay my brokerage. So a lot of times I get a question from people that's another myth of oh, well, I don't want to pay realtor fees. Well, if you're buying, you're not paying any realtor fees. So I'm a great resource for free that will help you have a successful home transaction.
Yep. Appraiser, you don't get to pick that, so there's no no option there. The attorney, both Michelle and I have great attorneys in our network that, again, we've vetted, we've worked with for years. We trust that they are very thorough. They're looking out for you. And like these other areas, there are different skill levels. If you have an attorney whose primary job is to do litigation or divorce law, and they just do a few real estate transactions here and there, they're not experts in the field. They don't know all the nuances, everything that's going on. And I've had plenty of those deals go south. I had once where an attorney whose primary job was DUIs. That's what he did day in and day out. And he tried to take not just a regular real estate transaction, a short sale. And he just completely screwed it up. So again, an attorney who's at least 50% of their business is real estate. If they do 2 things, that's fine. But if less than 10% of their business is real estate, they're not experts, and you want an expert. So again, we can connect you with those people. Title is something you don't have control over. So again, that's not an option. And then home inspectors, same thing. Michelle and I both have a network of home inspectors that we've vetted and have worked with, and we know they're thorough. They're looking out for your best interest. The one other thing I would say about home inspectors is that we want them to be a balance of being thorough, but not scaring the crap out of you, because some home inspectors make everything sound like a big deal. And then you're like, oh my God, this house is falling down. And like Michelle said, every house needs maintenance. So you really need to be able to piece out, like, these are the actual problematic things that I would consider canceling the deal over, versus, okay, these are just regular maintenance things that'll need to be done over the next few years, but it's not affecting, the health or safety or functionality of the house. So you want an inspector that's thorough, but not an alarmist. And I've met a couple of those in my day as well. And then Michelle, you want to talk about insurance?
Yep. So again, same with home insurance. You want to compare rates, make sure you're getting the best deal. Marla and I both have brokers that we work with that can shop multiple different vendors for you. I mean, another recommendation is to check with whoever you currently have renters or car insurance with now to see if bundling is an option that's going to save you money. Sometimes people, feel very loyal to a company that they've been with for a long time, which I understand, but I do recommend shopping around a couple of options just to make sure that you're getting both the best rate and the best coverage and understanding what that coverage is.
Next slide. Oh, hey,
I just want to jump on and ask another question.
Yeah.
And that's it seems like you have a lot of members on your team for buying a home, which is awesome, but how much does it cost to pay all these people? I know, Michelle, you were saying, you're more or less free if you're buying a home, voila. But Marla, how do you, do I pay you a straight up fee?
I'm more or less free also. There are some fees that go to my company for processing and underwriting, which is just the cost of that service, but there's no profit. My personal commission comes from what happens to the loan after you close. It doesn't come out of the customer's pocket. Of these fees, there are four that come out of the customer's pocket up front. So once you go under contract, you pay the home inspector. And I would say that's usually $450 to $750, depending on how big the house is. Is that what you're saying, Michelle, that range?
Yeah, I would say that's a good range. Again, some offer different services, and it depends on usually the size of the house.
Yeah. So home inspector, then the appraiser is usually $450 or $500. If it's a multi-unit property or something, it could be a little bit more. Then the other two costs that you pay are actually rolled in at closing. So the attorney, that's usually between, I've been saying the good attorneys that I would recommend between say it again.
I would say between $600 to $800.
That's exactly what I was going to say. So there are some that are less, but those are not the ones I would say are good. And they're probably costing you more money than you're saving on their fee. So the attorney and then the home insurance, and that's a wide range too, depending on the condition of the house, the age, the size of it. But the attorney and insurance get paid at closing. So if we negotiate these down payment assistance and seller credits to help pay some costs, some of those can actually get paid through those other sources. So that's when the situations where people are spending the absolute least, maybe $3,000 to buy a house, it's because we're having the seller and the down payment assistance program to cover some of those.
Okay, awesome. Yeah, so it does seem like you need a little bit of money to get started, even before you buy the house, just to make sure it's, it's worth it to spend $1,000 to make sure your decision is quality.
Exactly.
And something that Marla and I work together on is that we'll have you do the home inspection first, and typically we want you to clear the home inspection and clear attorney review before we have you pay for the appraisal, because we don't want you spending two out-of-pocket costs if you don't have to.
Right.
Definitely.
And this is definitely a piece of the home buying plan. When people get it, I give them a whole sample of all of the costs that breaks it down in much more detail. The reason I don't like to generalize that is because it can be very different depending on the purchase price range. Is it a condo? Is it a house? Is it a multi-unit building? But once we personalize it to their situation of what their target purchase price is, type of property, I give them in that process a sample of breakdown of all the costs to the very minute details. How much is the credit report and everything. So that's definitely something they'll get some additional information about once they get to that step.
Should have known you had it all bundled in, Marla. Should have known. All right, I'll let you guys get back to it.
A long time. So basically what I did is I sat down and was like, here are all the questions most first-time homebuyers ask me, and created my home buying plan on that format of here are the questions they ask, here are the answers. And I think it's pretty much hitting the nail on the head, because usually after I give them the home buying plan, there's very few questions afterwards. So I've covered those main questions that I've just heard over and over over the years.
That's awesome. Thank you.
Okay, so we've pretty much covered this with the pre-approvals, as far as just making sure you've got it all buttoned up front. You're qualified, so when you submit an offer, it's a strong offer. We know you're going to qualify. We've got your budget. We know exactly what you qualify for. We've maybe done some tweaks to increase your buying power, which there's some different things we can do to do that. And by doing everything thoroughly up front, we're preventing any potential problems that could cause delays or have issues later. So yeah, just really getting everything with the pre-approval and the home buying plan locked down early is your key to being in the strongest position to submit offers and get your offers accepted. This is just a rough example of some of the paperwork we'll need to review to see if you're pre-approved. It's going to be different for everyone. If you have a salary job, I don't necessarily need tax returns. You know, if you own other investment real estate, I'll need those mortgages. So the paperwork list is different for everyone, but you know, you will have to put together some paperwork so we can make sure that all the calculations are correct. Okay, so general do's and don'ts. Basically, we want to make sure to set you up for success. And so really the main point of this is anytime that there's going to be a change that might affect your qualifications, you want to consult us upfront. You're thinking of changing jobs, you're moving money around from different accounts. Anything you're thinking of doing, please talk to us first, because sometimes it's okay to do it, but there's specific ways you need to do it so we have a paper trail. Sometimes it's definitely not okay to do it and you're not going to qualify after that happens. So just generally, we want to stay in communication and be proactive about those do's. Again, if you're thinking of changing jobs or your job structure is going to change, you're moving to a sales position that's more commission from a salary position, any sort of thing that might affect your income, definitely consult with us. Make sure to continue paying all your bills on time, especially your mortgage and rent. Obviously, you don't want to damage your credit score or any of those histories. Anything that does happen, again, that you've consulted with us first to make sure it's okay, we need the paper trail. You took some money out of the retirement account or whatever that is, we need paper trail to show and connect all of the dots. And then just any other things, your car broke and now all of a sudden you need to buy a new car, well, we have to factor that payment in. So anything that's going to change your finances at all. The last one refers to travel plans. That's just as far as logistics, so we make sure you can be at closing. In some cases, people can't be at closing either because of travel plans or lately with COVID, some people have health issues and they don't want to, they're quarantining or whatnot. And so there is an option on occasion where your attorney can sign the closing docs on behalf of you. So here are the big don'ts. We don't want you to quit your job or change jobs, again, unless you consult with us. Co-signing for someone else. So like if your kid is going to college and they need you to co-sign on their student loans or take out a Parent Plus loan, even though you're only co-signing and they're the one paying it, that's going to affect your debt. That's on your credit report. We have to count that against you. Again, switching to self-employment. If you're self-employed, you need a couple of years to show that you do have that income before you qualify. So that's definitely not something you want to start new when you're looking to buy a house. We don't want you to close any accounts. When you close loans or credit cards, things like that, that hurts your credit score. Likewise, we don't want you maxing out your debt, especially for things like related to the house. People often think, oh, well, I'm buying a house, so I need furniture, and it's July 4th weekend, so there's a great sale, so I should buy all the furniture, and now they've maxed out their credit cards, and that can affect your debt. So we don't want to start spending a bunch more money unless you consulted with me. In some cases, I'll look at it and think, yeah, your debt to income ratio is very low. You've got plenty of room. Go ahead. but you definitely want to get that feedback first. And then again, moving money from different accounts. We want to make sure it's acceptable because some type of accounts are okay for using for mortgage, some are not. We want to make sure it's acceptable and then get all that paper trail to make sure where the money comes from. I always say only about 20% of what we do is actually seeing if you qualify for the loan and if you can actually afford to pay the loan. The other 80% is preventing fraud and money laundering. And I'm sure nobody on this call would consider doing fraud or money laundering, but that's the reason that banking requires so much. People always say, why do you need so much documents? Why do we have signed that? And that's the reason that they're really just trying to prevent what happened in the Great Recession, where basically rampant fraud in the mortgage industry led to an entire international crisis. So they have a lot of compliance now to prevent fraud and money laundering. So in addition to avoiding things that could hurt your qualifications, that's why they want all the additional documents and verifications and confirming if you're getting a gift, who is it from, and confirming that person's bank account, and all those little things that, again, the list so you know what you need. But yeah, banking is pretty thorough. So it's not just like we look at you and say, yeah, you look like a nice person, here's $200,000. It is pretty thorough, so you will have to jump through a bunch of hoops to get them.
So home inspection versus appraisal. A home inspection, like we said, it's really just a master list of all the facts about the home from a maintenance standpoint. All the windows, doors, floors, ceilings, outlets, electrical, plumbing, roof, exterior, all of those things are going to be included in the home inspection. And the home inspection, like we said, you get upfront during attorney review, after we've submitted a contract and it's been accepted by the seller. And again, home inspections cost between $450 to $750 and depends on the size of the home. We're going to look at the home inspection for the main big ticket items, anything health and safety, and all of the little stuff. Like there's going to be things that might sound like a big deal because you've never heard of it before, but we'll be able to tell you, either myself or the home inspector or a contractor, if we need additional information. Hey, I know that sounds really serious, but it's actually only a $100 fix or something like that. So the home inspection, again, is a list about the house. We'll review it. It's property specific. And I'll let Marla talk about appraisals.
Mm-hmm. So the appraisal is similar to what the realtor does with the comparative market analysis. Their goal is to figure out what the value of the house is. And the way they figure out the value is by looking at what similar homes have sold for. So if it's one of those neighborhoods where every house is cookie cutter and it looks exactly the same, and 3 other houses sold for $250,000, your house is also worth $250,000. If the houses are all different, they still take the houses that are the most similar and they make adjustments. Okay, this one's a little bigger, so it's going to be worth a little more. This one has a 2-car garage versus this one has a 3-car garage. So they make these adjustments to say, okay, these homes that are similar and have sold but are a little better, a little worse, and they figure out sort of like an average of what the home is worth. And again, if your real estate agent did a good comparative market analysis and is knowledgeable about that, the appraisal should come in similar because they're looking at the same data and analyzing the same factors. And the appraised value is important because as a bank, we want to make sure the house is worth what you're paying. If you are paying more for the house than it's worth, we want our loan only based off what it's worth. And that's actually something that you see a little bit in a market where values are increasing. It can be a little bit tricky because appraisals are looking at historical data. They're looking at data from like the past up to 3, sometimes up to 6 months, sometimes a little more depending on the market. But what sold 6 months ago in a hot market where values are increasing quickly, the values may already be higher. And there may not be new sales to support that because the values are increasing. So sometimes we get into situations where, the appraiser says the value is a little lower than what you're paying for it. And then there's some different options that we have. I mean, the best case scenario is that the attorneys negotiate and the seller agrees to drop the price to the appraised value. So then you get a lower purchase price. So you're saving some money. In some cases, if it was a competitive situation and the seller had 10 offers, they may say, no, if you don't want it at this price, we'll just go with a different buyer. In which case that you may have to cover the difference. If it's, let's say it's $3,000 low, you may have to bring that extra $3,000 on top of your down payment and settlement costs you were planning to bring already. So that sometimes happens. Sometimes the attorneys negotiate and they split the difference. So if it was $3,000 low, you each bring an extra $1,500 to cover that difference. Or it may be a situation where you decide to walk away. You say, I don't want to pay more than it's worth, which logically sounds reasonable because most people don't want to pay more than it's worth. But in a market where values are increasing and they're continuing, the projections are strong that they will continue to increase for several more years. So you're catching it like at this part of the slope, but it's going to go up. So eventually your value is going to match what you paid for it if you paid a little more than what the appraiser thought it was worth today. And that can be sort of a personal decision and a financial decision that, if it gets to that point, we look at that and say, okay, this is how much money you'd have to spend. These are the factors to look at, and you make a decision if you're willing to do that. But that is something we're not saying it on every house, but maybe 5% of the deals we're seeing. And that's, again, just because the value is going up and appraisals are looking at the history, the past. They're not able to just project out to the future. So that is something we're seeing a little bit of. Do we look like our pictures? I'm going to do like the Michelle pose. Put my head down.
Wow, that was a lot of great quality information. I think I'm ready to buy a home.
Actually, I did want to add one other thing that we didn't have a slide on. Michelle, in the beginning, touched on a little bit of different purposes for real estate. So living in a home versus investing in a home. And Michelle also touched a little bit on if you find a home that needs some repairs, that she has contractors in her network, things like that. One thing to know is that both Michelle and I have experience with buying investment properties, renovating properties. And so in addition to knowing like the textbook things about that, we have that tangential experience that we can talk to you about that. So if you're looking to buy a home that needs some work, or you're not looking to buy a home that needs work, but after you do the inspection, you find out it needs work, we can give you insight on that. And there are actually, this is a whole different presentation, but there are loans that actually can include money to buy a home and fix it up. So if you really intentionally want to find a home, that's decorated from the 1950s and, you want to do that HGTV home improvement project, we do have options for that as well. And Michelle and I both have experience with that personally.
Awesome. Well, it sounds like a lot of people have some great information that they can kind of pull together. And then next steps would be, I know you guys mentioned you can either contact Michelle or Marla first. There's no right or wrong way to start this process.
Yep.
And so both of your email addresses are here, and we'll make sure those are in the handout tomorrow as well, so you can contact Marla and Michelle. Let me give a couple minutes to see if any other questions come in here. But you guys were just so thorough and really covering all the great topics that every question we had, it was answered.
Yeah, that was awesome. I just think the conversation and the information is so pertinent to today, since home, everyone's really looking at buying a home. There is a lot to it, and what I love is having experts like the both of you at the table, because your knowledge is so deep. I mean, I've bought and sold a few homes, but I'm always learning something new, and I think the process changes a little bit. Also with COVID, there's some changes as well, but I really think it's important to know the process. Like you say, Marla, you're not going to be expert in all these different pieces and parts. That's why you guys are the go-to people. So if like Maggie said, if someone's like, you know what, now you've got me curious about maybe looking out there at something, the rates are really good, and I'm renting, and maybe I can really invest now. do I call Marla? Do I call Michelle? Where do I get started? Get pre-approved or look for something that's interesting to me?
I mean, before you actually look at properties, you do need to look at the numbers. So if they call me first, we can run through that. But if they want to talk to Michelle just to get a rough idea of the properties and go through some stuff first, it's not wrong to go to her first. But before she actually shows you home, she's going to send them over to me to make sure the numbers.
Yeah.
So there's no wrong answer which one you want to talk to first. But either way, before you actually start looking at homes, you need to go through the numbers.
Got it.
Awesome.
Yeah.
I mean, one other thing I would mention to people watching is because these videos are recorded, if you know anyone else who's thinking of buying a home, feel free to share the links with them and, or any of the other topics from the week, someone who, needs some insight on retirement planning or whatever the other topics we covered. You can share these videos with friends. Obviously, because it's in the group, they would need to join the group to see it. But they're going to continue to be available, so this content will be on the group.
Yeah,
and I want to say a huge thank you to Liz, for having the VIP group for women, period. And I mean, we've met so many wonderful women through this group. I love that Liz's mission statement is to support other women-owned businesses and to empower women. And I think that that's so in line with purse strings and Marla and I's personal philosophies about empowering women. So big thank you to Liz. I just want to acknowledge, because I feel like Liz uplifts everyone and is constantly generating great discussion topics. I mean, we've all shared some great things in this group, and I just want to thank Liz for having us today.
Yeah, I agree. Thank you, Liz, for allowing us your platform to share this important information for women and to get the knowledge out. We have to consistently make sure that women are empowered with this great knowledge and skill and excellent resources like Marla and Michelle. So, this has been great. Any last words before we wrap it up?
I think it's been a fun week. Purse Strings has been so happy to be here and share our professionals. Anyone feel free to reach out to Purse Strings, Michelle, Marla, or any of our other professionals earlier this week. And if you have any other financial education topics or questions, we always have professionals to help you out. So just reach out and we can give you some resources. So thank you again, Liz, for letting us come in this week. Thank you again to Michelle and Marla for also helping make this all happen. So everyone have a great rest of their Saturday.
Bye, everyone.